All right, futures rising after inflation came in exactly as predicted in every single category. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak on assignment, and Bloomberg Open Interest starts right now.
We expected it, and it happened. Core inflation rising again. It's the fourth straight month, firming up bets the Fed will cut rates at its next meeting. I don't know why that would make them want to cut rates. Anyway, Janet Yellen, the first woman to head the U.S. Treasury, sits down with Bloomberg's David Gura as she prepares to leave office. We'll bring you that exclusive interview at 10:30 a.m. Again, Janet Yellen at 10:30, and the fallout from that multi-million-dollar accounting error, or was it an error? It was done on purpose, but they found out someone was hiding shipping costs, and it's going to hurt profits, so the shares are down. Let's take a look at where markets are trading right now. In terms of futures, they actually picked up after inflation came in much higher than it should be, right? 3.3% was the core inflation year over year. That's a number that we want to have lower, and yet it looks like the market thinks that reinforces the chances the Fed is going to cut, at least from this reaction in NASDAQ to those futures up 0.6%. And investors are buying bonds, pushing the yield down. Okay, it's not even really 1 basis point at 422, but still, it's there.
Well, Matt, as we talked about, the Fed is looking through inflation rising. Of course, they're going to cut rates. We know that. Inflation be damned. Let's talk about what's moving under the hood right now, because Matt mentioned MACY's, and we have to talk about it, reducing its profit outlook after concluding that investigation into an employee who hid millions of dollars in expenses that ultimately weighed on gross margin for the year. Shares down 11%, even though a lot of people were anticipating that we'd get bad news today. Let's talk about Albertsons, though. Of course, Albertsons terminated its proposed merger with Kroger after it was blocked by a judge yesterday. And then this morning, Albertsons also filed a lawsuit against Kroger, claiming that it failed to exercise, quote, best efforts needed to secure regulatory approval for the deal. Albertsons shares up about 2%. And let's end, this is C3AI, but I actually want to talk about Supermicro, because the CEO said that he's confident the firm will remain in the NASDAQ 100 amid concerns on Wall Street. Shares have dropped more than 50% since EY resigned as its auditor in October. I couldn't tell you what Supermicro is doing right now, but now I can.
I know.
Shares are down about 5%.
Yeah, the same as C3AI. So in the end, it didn't really make a difference.
There you go.
Let's get downtown right now. Here in Manhattan, Goldman Sachs is hosting its annual financial services conference, and our co-anchor, Sonali Basak, is back from London. She's there at the conference. She's got a great lineup of interviews to bring us throughout the show. What are we looking at, Sonali?
A few things. You know, there are more than 1,300 people that have been registered to this event downtown. It's a conference that Goldman holds every year. But remember, Matt, actually, when you look at the stock prices this year of the banking industry, of the big six banks, none have risen faster than Goldman Sachs, up almost 52% this year alone. On the heels of that big M&A comeback that investors are hoping for, we're going to talk to the CFO of Goldman Sachs and hear about how strong that pipeline really looks under the hood. We're also going to talk to the CEO of PJT Partners, where, of course, they are also working on big ticket deals and big ticket capital raises like that of Boeing's. Mike Arougheti will also be able to talk about that private credit outlook. Marc Nachmann, also of Goldman Sachs, not just private credit, but Katie's favorite topic, ETFs, and seeing if they have some M&A ambitions on their mind. What's going to drive growth next year? We've seen this huge run up in the stocks already. Let's see if there's more where that came from.
All right, really looking forward to that lineup. All of that coming up over the next 2 hours with Sonali. But let's get back to markets and what they're doing in reaction to that CPI print. Bang in line with estimates, as Matt walked us through. Let's get the details now with Bloomberg International Economics and Policy Editor Mike McKee sitting to my left. So markets clearly like this. Talk us through the fact that inflation is actually rising a little bit right now, and the Fed is going to cut rates?
Well, as they say, the devil is in the details. And let's stretch that out to keep these people in suspense here. First, talk about what happened. The headline numbers come in, as Katie says, bang on, up 0.3 for both the headline and the core. And they were a fairly strong 0.3. They were above the 0.3. They weren't rounded up to that. So it does suggest some inflation pressure. But now here's why. Take a look at what moved. Gasoline prices up 0.6. That hasn't been the case lately, and we're expecting it to go down again this month. Used cars were up, and we've had to sell a lot of used cars because so many were destroyed in the hurricanes. Car insurance, though, just up 0.1. And here's the big mover. Here's why the markets are excited. It's housing. Owner's equivalent rent comes in at the lowest since 2021, January of 2021, when Matt was still looking for a house upstate. It is the lowest number we've seen in quite some time, suggests that what the Fed has been waiting for may now be on its way, and that is downward pressure on inflation because housing is coming in lower. We'll see if that continues, but boy, that's something that everybody's going to look for in the December report. So where are we? Fed funds futures suggest a cut is priced in, as both Matt and Katie were saying. We were up to 97% certainty, which is about as good as you can do, given the way these things are calculated at this point. Now people believe that the Fed will go ahead. Nothing in these numbers, and especially that housing number, suggesting that progress is still being made on inflation.
Yeah, to hell with data dependence, right? Mike McKee, thanks very much for that. Let's get to Victoria Fernandez. She joins us now from Crossmark, where she is Global Investments Chief Market Strategist. Victoria, great to have you on the program. What do you make of these markets? I mean, we want a rally, right? The Fed wants to cut. Nothing's going to stop us this month.
Well, at least not the CPI number, apparently. So numbers came in spot on, as you guys have been talking about. I do think Mike's right when he talks about the devil being in the details. Yes, the rent component's coming down, but as he mentioned, there's other elements that have been negative that are now going positive again. So it's really a give and take. Food was up, apparel was up, which was negative before, used cars is up, food away from home. All of these elements that have been kind of volatile were moving higher. I didn't see what the super core number is, but you look last month and we saw that up almost 4.7, 4.8%. So inflation is still there. I think the fact that it came in as expected will not change, therefore, what the Fed is going to do at their meeting. It feels like they are very determined to cut rates, and that has been supporting the economy, not just central banks lowering, but the seasonality we have going through the end of the year and through inauguration. There's seasonality. Sentiment is high because we feel like there's going to be a pro-business administration coming in. That should be good for businesses, good for the labor market. So there's these elements that are supporting this economy, but I do think we have to be a little bit cautious once we get through the inauguration. Choppy markets will probably be coming back.
What does cautious look like for you? How do you design a portfolio around that stance? What's your haven?
Yeah, so when you're cautious, it doesn't mean you want to be out of the market. We're not going to cash. We have not gone to cash at all, through the last few years. It just means be in the market. You want to take advantage of the upside that we're seeing there, that seasonality and that positiveness that we're seeing. But we're looking for areas within the market where perhaps there are areas that have pulled back as of late, where the growth potential is there, where the valuations are not as high. So you look at something like financials, where you're getting outperforming the S&P overall over the last 12 months, but at a valuation that's about 60% of that of the market. So those are the types of things that you want to do. Find areas that you can invest in and still be part of the market, but be a little bit cautious. And I would say that means also adding some to fixed income and locking in some cash flow there.
Do you look at anything, Victoria, that's underperforming in this, runaway mega cap market or in another region and say, I think that has some value?
Probably where we're looking that fits that criteria is in healthcare. I know we've had Lilly talk about their buybacks and their dividends, and so that had a little bit of a bump. But you look at a name like Cigna, especially over the last week, where a lot of the healthcare stocks, because of the very unfortunate incident with United Healthcare, they've all taken quite a bit of a hit. I think Cigna was down 5-6% this morning. Those are an area where you have a company that has a strong balance sheet. They've had good earnings. They're not exposed to some of the regulatory elements with Medicare and Medicaid, and yet they're doing really well. And so that's a name in the healthcare space that we like. So look for something like that. That would be a downtrodden sector I think you could find some value in.
All right, Victoria, really appreciate you taking the time this morning. That is Victoria Fernandez of Crossmark Global Investments. And we do want to bring you some breaking news. This from The Information reporting that Apple is working with Broadcom to build an AI chip for its products. That chip could be ready for production by 2026. That is according to that report, again, coming from The Information. You see the reaction in shares right now. Apple moving a little bit higher, but the real action is in Broadcom. Shares up about 4.8%. Of course, this would absolutely be a win for Broadcom. And bringing back to that headline, this coming from The Information that Apple working on that AI chip with Broadcom, Matt.
Yeah, fascinating stuff. Obviously, Apple at almost $4 trillion, right? It's $3.7 trillion, a much bigger company than Broadcom, which is worth a little more than $800 billion right now. But that could change, obviously, NVIDIA style, if they come out with a chip that rivals the Hopper or the Blackwell and is able to sell in scale. I think probably a relatively difficult proposition, but we'll see, they say, by 2026. In terms of the markets right now, we see a rally in futures, and after the inflation number came out, it just went straight up.
Yeah.
So it was already positive, and yesterday was a down day, but...
And the day before. We've had a really rough start to this week.
Still over 6,000 on the S&P 500, right?
But,
we fell to 6,034, I think, yesterday at the close.
After 28%, though, year to date, I'm feeling a little greedy here. So to see two down days, it's definitely not what we're used to. As you can see right now, that is set to break, though. The S&P 500 up about 0.5% pre-market. Big tech back in charge. Have to imagine that this reporting from The Information will help lift the index when you think about Apple and Broadcom both moving higher. The NASDAQ 100 up about 0.8%. The small caps, too, they've been underwater this week, but seeing a little bit of relief this morning. The Russell 2000 up about 0.7%. And we have a pretty good explanation for that. Rates coming down, the small stocks go up, and that's the playbook this morning.
Yeah, and you have some good news outside of that. Some buyback news from Mondelez, right, to the tune of $9 billion. You have, I think, good news for Tesla that GM is pulling out, and that's good news for GM as well, of Cruise. Coming up, we're going to head to the Goldman Sachs Financial Services Conference with Dennis Coleman.
Welcome to our Bloomberg Television and radio audiences. I'm Sonali Basak, and I'm standing by with the Chief Financial Officer of Goldman Sachs, Denis Coleman. And I know, Dennis, that you are deep into planning for 2025. What is your #1 priority as you head into next year?
Well, first, Sonali, let me just say welcome to the Goldman Sachs Financials Conference. It is our 35th annual. We have over 100 issuers here, as many as 1,400 other guests interested in the financial sector. So a really big event, and we're really happy to have Bloomberg here with us today. In terms of our priorities, as we head into 2025, given our outlook and given our two world-class interconnected businesses, we are really optimistic on the prospect to continue to drive growth for our clients and for Goldman Sachs. And so my #1 priority is making sure that all the people of Goldman Sachs are front-footed and focused on clients. We can serve them as best we can heading into 2025. Many of the other things should take care of themselves.
Front-footed and ready to go. You know, if you take a look at the market reaction, you see so many investors betting on investment bank stocks, Goldman benefiting more than any of the big 6 banks out there. Your stock is up more than 52% this year. What does that mean in terms of what investors should expect for next year? Is that runoff justified? Is there more to come? How much activity should they expect?
So I think what investors see is a combination of factors. They see an improving macroeconomic backdrop. They have increasing optimism about the growth trajectory in 2025. And they recognize that Goldman Sachs has established leading market share positions across both global banking and markets and asset and wealth management, certain of the activities within our portfolio of global banking and markets have not been performing at their ultimate potential, yet our rankings and our market share positions are absolutely top. And so as we see an uptick in activity heading into 2025, I think they appreciate that our firm, with our client franchise, should be able to drive a lot of elevated activity.
Do you think there could be some choppy waters on the road to more M&A? You look at just the last couple of weeks of the Biden administration, you see the Kroger-Albertsons deal fall apart under the weight of the FTC. You see a bigger crackdown on that Nippon Steel-U.S. Steel merger from the Biden administration. And you have Trump naming somebody to lead the FTC with Andrew Ferguson. Stack it all up together. Do you think that there could still be headwinds to M&A given the future antitrust environment and the one that we're still making our way through today?
So I think we've seen some sustained growth in M&A activity, moving towards sort of the average levels of activity over the last 10 years. There have been a number of headwinds to the unlocking of the ultimate quantum of M&A activity over the course of the last year. I think with Ferguson's nominee, there could be a new direction at the FTC. He obviously, as a sitting commissioner, dissented with the current leadership on a number of cases. And so we could see a more favorable environment heading into 2025 that could actually spur more by way of CEO confidence and in turn unlocking more investment, more activity, and provide a more favorable strategic backdrop.
Now, what is it that you're preparing for? We've had bankers tell us, investment bankers across Wall Street tell us they're preparing for the return of the mega deal. Do you think big ticket, more than $50 billion deals can come back at scale?
So we historically have the leading market share in both announced and completed M&A over many, many, many years. And a big part of that franchise is doing some of the biggest deals as they present themselves for opportunities. As we move into 2025, given where the markets are, given the backdrop, given the quality of our client franchise, and given the level of engagement that we've seen post the turnover in the administration, we are optimistic about the prospect for more deal flow. And in particular, we see through our business inquiry coming from clients for more by way of capital committed financing transactions. That is in and of itself a signal for a different type of transaction and a different level of activity. Dovetails very well with our capability set, and I think is reinforcing of the prospect for more deal activity.
You know, it's interesting. As I sit here with you today, you also had that CPI report and an inflation report that did drive yields lower. But when you look across the horizon, you are looking at a lot of uncertainty when it comes to the interest rate outlook from investors. How much can that throw a wrench in the activity for next year? Are you worried about the direction of interest rates, especially if tariff policies were to drive inflation higher?
So interest rate policy is obviously a really big piece of the equation. Overall level of interest rates coming down. Notwithstanding the CPI print this morning, I think we're still pricing a greater likelihood of a 25 basis point cut into the end of this year, the December meeting. As we head into 2025, there are some uncertainties. We'll have to see what types of policies present themselves. We'll have to see how the economic growth continues to unfold. There currently are more cuts priced into 2025. But that type of environment where you have rates coming down, you still see sustained levels of GDP growth, unemployment under control, that is a favorable backdrop for ongoing levels of deal activity.
So do you worry at the end of the day at all about the necessity for an interest rate rise even next year, or do you think that wouldn't even be on the table?
I'm in the business of worrying about a lot of things. As a CFO and as a CFO of Goldman Sachs, we see risks in many different places. So we're always focused on sort of counter consensus moves that could occur. But I think the consensus that we're seeing in the way the markets are pricing things and what we're seeing from our clients and based on their own behavior, for the time being, the base case expectation is for an improved and benign backdrop. But of course, the unexpected things can happen and we need to be prepared for that.
What is your biggest worry when you head into 2025?
So there are, again, long list of things that we need to be focused on. The things that are very much top of mind for me these days, geopolitical risk. Recently we discussed, and in the last week alone, we've seen, government disruptions across Korea, across France, across Syria. That's just in 1 week. So it's a reminder that around the world, there are levels of instability that you need to be mindful of. I'm always, quick to point out that cybersecurity is a risk. It's a risk that all of us experience operating in a global and interconnected world. So just off the top of my head, those would be two things I would flag for you, Sonali.
Another thing you mentioned a little earlier is that your number one priority is to get your people on their front foot for next year. What does that mean? If you think about the talent story, is Goldman Sachs ready to be hiring bankers once again to capitalize on that M&A activity? How do you think about where you stand on the talent story today?
So talent is a mission-critical component of Goldman Sachs. It's one of the most important things we need to be successful as a company and successful for our clients. Very proud history of attracting the best and brightest, developing them, and then making sure that we create the kind of work environment, client franchise that makes them feel confident they can develop long-term productive careers at Goldman Sachs. I think there's an excitement that they feel in terms of the overall uptick in activity. These are professionals at the top of their game, and they want to be involved in some of the most impactful and consequential, developments that occur across the global capital markets. I think they recognize that being part of our platform is a really special opportunity for them to realize their potential and serve their clients as best as they possibly can.
Does that mean it's kind of like a now hiring sign for Goldman Sachs, or do you feel like you have what you need to get the job done for next year?
Fair question. So we're always focused on ensuring that we have the absolute best people in almost every sort of subsegment of our business. We feel really good about the team we have at Goldman Sachs. We feel really good about the depth of the team that we have at Goldman Sachs. In many respects, Goldman Sachs is the talent factory. And I've been at the firm almost 30 years, and we develop really highly talented professionals. At some point, they leave the firm, and then there's another professional that steps right into the shoes and carries on the strength of our franchise in a really positive fashion.
A little earlier, we were talking about how Goldman stock has risen well over 50% this year already. What's going to drive the next 50%? Because you think about those drivers for your stock. Is it the M&A story? Is it that push into asset and wealth? What should investors be hanging their hat on?
So our story at this point is pretty simple. We have two world-class businesses, both of which are positioned to grow into 2025. On the global banking and market side, the piece of the puzzle that we could see incremental growth unlocked would be through ongoing capital markets activity, and particularly capital markets activity that is connected to strategic activity. So less by way of plain vanilla or refinancing activity if you think about the debt markets, and more change of control or deal-related activity, which is something we're particularly good at doing for clients. We can see more of that activity. That will propel growth across that segment. We have a global broad and deep FICC and equities business, leading positions in the equities business. Number one, top three in FICC, covering the whole globe across products. That remains an attractive opportunity set for us. And the big growth engine for the firm sits within asset and wealth management, where we've communicated publicly we expect to drive top-line revenue growth, high single digits, across the durable revenue streams of management fees, private banking, and lending. And our optimism for that is unchanged, and we continue to drive margin improvement towards our mid-20s targets and unlock better returns.
How much will lighter regulation make a difference for you, with the expectation that things would be lighter under a Trump administration?
Should we have lighter regulation, which I think is our expectation? I think it's the expectation of the markets. That can just reduce sand in the gears of activity across industries, across the globe, give people more confidence that they can actually go out and try to affect strategic change that they need to grow their business. That should catalyze more activity across our franchise. We and the whole sector should be beneficiaries of that environment.
Dennis, thank you so much for joining us here at your conference. Of course, this is the Goldman Sachs Financial Services Conference. That is Goldman Sachs CFO Denis Coleman. Guys, back to you.
All right, our thanks to Sonali Basak down at the Goldman Sachs Financial Conference, and many more guests coming up over the next 90 minutes or so. As you can see there from that lineup, a lot to look forward to. But let's get a check on these markets right now. You can see we have a rally underway, and it is gaining momentum right now. The S&P 500 up about 0.5%. Big tech in the lead right now. The Nasdaq 100 up about 0.8% with just a couple minutes until the bells ring. And then the small caps also higher, actually giving tech a run for their money, because the Russell 2000 now up about 0.8%. All of this in reaction to a pretty boring CPI print, Matt Miller.
Yeah, I mean, it was boring in that it came in line with expectations.
Just rooting for some chaos.
It was, as I understand, in this desk. But it was not boring in the sense that it's still on the wrong side of 2. It's on the wrong side of 3, right? The core, I mean, Mike talks about gas prices, but those are transitory, right?
Yeah.
The core was up 3.3% from last year. Inflation is still too high, and yet the Fed is determined to cut.
We need to get some Fed officials all in one room, and we need to ask them, why are you cutting rates right now? Maybe we'll do that next week, of course, with that Fed meeting. But coming up, less than 4 minutes until the opening bell, we'll discuss the market moves with Ann Barry of Threadneedle Ventures. This is Bloomberg.
All right, we are less than 30 seconds away from the start of trading. It is exciting. This is Bloomberg Open Interest. I'm Matt Miller. Futures are higher after it feels like the market's been falling for forever, right? 2 days in a row down. Now we're up 0.5% on futures, up almost 1% on NASDAQ futures, and Russell 2000 futures are rallying as well. So you hear the opening bells. This is also pretty exciting. Olin, which is a company that over the last 5 years has more than doubled. If you reinvested your dividends, is up 150%. They also make Winchester ammunition, which is used for hunting and sporting clays, law enforcement, military, but they make the clays as well, sporting clays, which I think is pretty cool. Down at the NASDAQ, the people from CoinCheck Group, which is like a Japanese crypto trading firm, decided to check in. In terms of the major averages, it looks like, at least for now, we're going to see gains. Katie Greifeld, isn't this cool?
Finally, some action at the open. We've had 2 days of very quiet opens, and then we just sort of dribble lower throughout the day. It's different today. On this Wednesday, you can see that the S&P 500 higher by about 0.5%, just 45 seconds into trading. A similar story if you take a look at big tech, back in charge, but fighting for the lead with the small caps. But the NASDAQ 100 higher by about 0.8%. The Russell 2000 also back in business here. Of course, the logic with that as expected CPI report is that REITs are going to come down. The small caps are going to go higher, and that's the logic today. But let's take a look under the surface right now. We have a report from The Information that Apple is working with Broadcom to build an AI chip for its products. Now, that chip, according to this report, could be ready for production by 2026. You can see that's boosting Apple a little bit and Broadcom by a little bit more, up about 2.8%. We also want to talk about Albertsons because it's terminated its proposed merger with Kroger after it was blocked by a judge yesterday. Albertsons also filed a lawsuit against Kroger, claiming that it failed to exercise best efforts needed to secure regulatory approval for the deal. You can see the reaction in shares right now. Albertsons a little bit higher, Kroger a little bit lower right now, Matt.
Yeah, I think that's a pretty fascinating story, right? Albertsons gets $600 million breakup fee. I assume that they get that, but they're suing for billions more, and they're saying that Kroger, I guess purposely, didn't work with regulators.
Sounds like it. Scuttled
that deal. All right. Macy's is also a story that we're watching, cutting its profit outlook after an employee intentionally hid over $100 million in delivery expenses. That's going to weigh on full year margins and earnings per share to the tune of like $80 million. So not good for the company. You can see the stock has been decimated today, down 10%. Mary Ross-Gilbert joins us right now from Bloomberg Intelligence to talk about what's going on here. And I guess, is this kind of a sideshow, Mary, to the real story, which is that the company is like imploding, so they're going to have to sell their real estate?
The company is not imploding. In fact, now that this is being put behind them, you know, they've gone ahead, they've made adjustments to their financial controls, they've improved it. And so while there will be an impact in terms of the gross profit, I think the biggest impact to the gross margin really in the fourth quarter is going to be that they have to take markdowns on cold weather merchandise. But other than that, if you look at the sales trends, they actually improved or raised their guidance for comp sales on a 13-week basis to be down 1% to potentially up 1%. So we think that's more positive. And I think if you look at the more go-forward story, we're seeing some green shoots there. Their first 50 stores that they've remodeled, they posted their third quarter of comp sales increases. They were up 1.9%. So there were actually a lot of green shoots in the quarter.
It does not seem terribly exciting, Mary, I'm going to say. And we talked to, people, the few people that were there Black Friday at the Herald Square store. You would expect like doorbusters, but it wasn't the case. The brick and mortar retail business seems sincerely under pressure from online retail. And in my experience, when a company decides it's time to start selling its real estate, or when activist investors put pressure on it to do so, that's like a death knell. You're really optimistic on this?
Well, let me clarify some things. So with regard to the activism, and of course there's been a slew of activism with this company. In the latest overture, which this would not be in the form of an acquisition. They're proposing that the company form a propco, as you pointed out. What they would do is basically take the real estate, which we value around $8 billion. This activist group, which is Barrington, led by Barrington Capital, and also Tor Equities, they value it as much as, or as high as $9 billion, as low as $5 billion. And they would put it into a separate entity, but what they're going to do is then raise the rents to market rates to the retail business. What that does is it takes their profitability down in half. And when you look at their CapEx plan, and this is one of the other things they're proposing, is it should be as low as Dillard's. But really, you can't look at Dillard's for a number of reasons. We could talk about that more, but there's probably not time for that. So we think that some of the proposals here don't make sense. And when they're proposing to take the luxury units and monetizing those, essentially an outright sale, we think maybe it makes sense to create a tracking stock and spin off a minority stake in the luxury units. And this provides more transparency and also improves the valuation of the overall operations. But we think creating a propco on the real estate is not something you can really do for department stores.
Yeah, and it seems like any way you slice it, it's an uphill climb here. Mary Ross-Gilbert of Bloomberg Intelligence, great to get your perspective on a pretty terrible day for Macy's shares, down about 10%. Let's keep this conversation going now with Threadneedle Ventures founder Ann Berry sitting to my left. Great to see you in person.
Good to see you.
So the Bloomberg Intelligence take is that Macy's isn't imploding here. What's your take?
I think it's got an existential crisis on its hands. It's had for a while, and I think it's really coming to fruition. I think 2025 is going to be the make or break year for Macy's.
So what happens in that case? I mean, does it just continue on as a zombie retailer? It's got an incredible brand, right?
Does it?
Well,
does it?
No, but I mean, they own Bloomingdale's.
Right, well, that's different.
Yeah.
Well, let's have that conversation. So Mary drew a comp in there as Dillard's, right? Dillard's, right, as a Dillard's and Bloomingdale's can't exist in the same sentence, right? Neither can Bluemercury, which is the luxury beauty retailer that also sits in this portfolio. So I think this idea that Macy's should get broken up, the activists are saying that. They're saying, number one, you should have OpCo, PropCo. I have a different perspective on that. If it works like it does in hotels, it's great. If it doesn't, you've got Toys R Us on your hands, right? But I think Macy's has an existential crisis, Matt. It doesn't know what its brand is. It's certainly not compelling. The experience isn't exciting no matter how much they refresh their stores. Bloomingdale's probably shouldn't belong there, and Bluemercury doesn't either. So I think it really needs to come up with something dramatic.
What do you have confidence that they will, though? Because, I mean, the set of circumstances that you just described sounds pretty dire. I mean, as an investor, what would you like to see? Not that you're an investor in Macy's, but, I mean, how are you thinking about it?
Well, private equity circled Macy's earlier this year, and that deal went away. And I remember thinking, brave souls who try and take this private, and the private equity firm in that case was really real estate heavy. They weren't so much the sort of retail operators. If I built a thesis around it, I would look to break up the business. I would look to take Bluemercury and set it up as the sort of luxury mini Ulta, which has had challenges but has opportunity. And I think Macy's needs to turn itself into a really great experiential destination in the markets it's in. It needs to have great activities for kids. It needs to have great beauty services. It needs to have great, I don't know, pop-up concerts or something, but it's got to start doing something dramatically different.
All right, so I'm imagining that's not a sector that you like anyway,
stores,
right?
It's a tough one.
It's a difficult sell in this day and age. What do you like? You know, what is front and center for you? When you wake up in the morning, is there an investment where you're like, this is so baller, like I got to tell everybody about it?
Can't wait to check it.
I wake up in the morning and go, this market is so expensive. That's what's going on at the moment. But the one sector that I've liked for a long time, and I can give you some history on how I've played this, sometimes successfully, sometimes less so, is the cruise industry. You know, back in 2012, actually, when I looked at working as a private equity firm at starting a new cruise line industry, and the thesis was only about 5% of the US population cruises. There's space to build more ships. It's a fantastic value proposition for the consumer. You get this all-inclusive vacation at a discount to the land-based equivalent, and you get to see the world. And there's a captive market, right? There's only so many amounts of it's called hardware, these big ships that are out there. Carnival's been doing pretty well. And it's coming out of a period where I felt it's been over-levered. It was hard to see a very clear path to it getting to normalized leverage. It's trading at sub 10 times EBITDA, which I like for this kind of business, and I think it's got really good tailwinds, given where the consumer is.
So good fundamentals, and it sounds like not too expensive there. I do also want to talk about live entertainment.
Yes.
This caught my eye in your notes that you're into Live Nation. We were just talking about this because Coldplay sold out, what, 10 dates in London?
They sold 900,000 seats at Wembley. Coldplay.
It's crazy. Again, easy listening. A lot of people like Coldplay, but talk us through.
I guess Oasis maybe brought it back to some extent.
That's true. And
a lot of people don't know the difference between those two bands.
That sounds somewhat similar, but talk us through that thesis here. Of course, we're just saying goodbye to the Eras Tour. That, of course, was a huge success. And I don't know, it feels like it's hard to sort of beat some of those comps there.
I think it's hard to say what's the next blockbuster tour, right? What's the next Taylor Swift tour? I think that's a difficult comp. But the thesis on this goes actually back a couple of years. And it was actually in the depths of COVID. It was funny. I was actually in Vegas, and I remember this so clearly in summer of 2020. And the gentleman who used to run Dick Clark Productions, and called me to check in how I was doing, said, Anne, there's going to be enormous pent-up demand for Vice when we're through this. And he really meant people want to get back out and do experiences again. And I took that to heart.
He called that Vice?
Well, Vice because I was in Vegas, so he's kind of riffing on the location. But the idea was back to in-person, back to humanity coming together. We've seen that. We've talked about the revenge spending a ton. But I think that continues. I think as the world gets more and more digital, the world is also going to get more and more in person on the other side of it. And I think Live Nation, I went into that about 40% up at this point, was really a play on music. I've done this in other music venues and in music festivals. I think it continues. And I think what we'll actually see is more localized activity. We think about these big blockbuster tours. I'm invested in this business called TVG that looks at smaller markets. They built an amphitheater in Huntsville, Alabama, which is doing unbelievably well.
Wow.
There are these markets that aren't on the sort of major headline tour paths that are really hungry for venues and for artists to come and visit them, and they're doing unbelievably well. I think that continues as localization.
All right, so some things maybe people want to do in person, like cruising or concerts. Some things not, like shopping or go to Dave & Buster's, apparently.
That's true. And it never feels like enough time. It's really great to see you in person. That is Anne Berry from Threadneedle Ventures. Now, coming up, we turn back to the Goldman Sachs Financial Services Conference with PJT CEO Paul Taubman coming up next. This is Bloomberg.
Now let's head back to the Goldman Sachs Financial Services Conference in downtown Manhattan. Sonali Basak is there with PJT CEO Paul Taubman. Sonali?
Thank you, Matt. Yes, I am right next to Paul Taubman right now. A lot of investors asking about that M&A boom that could be expected for 2025. What do you think? How big can it get?
I think we're on the verge of a really big uptick in M&A. We came into 2024 thinking that the marketplace was way too optimistic about 24, that there were a number of planks that needed to be built. I think almost every one of those has been built. We've gotten through elections around the globe. We've seen rates crest start to come down. We've seen a change in administration, which will create a more favorable regulatory review and competition approach. Private equity has gotten their balance of investment and monetizations better in line. Corporates are still active. So we look at 2025 and we just can't wait for it to get going. My prediction is, other than 2021, which was an aberrational year, this could easily be the best M&A year we've had in say, 10 years.
How do you prepare for that? Does that mean PJT is ready to go out on a hiring spree? I mean, what does this mean in terms of the talent you need, the workforce you need to prepare for something that could be another start of a cycle?
Well, we knew that ultimately we were going to be in an environment like this, and it's not just about 2025. I think we are in, a multi-year cycle of extended M&A activity. If you go back in 22, 23, and even 2024, that's not the steady state environment for activity. And that's why we were so aggressive in hiring these last 2.5 years. You can't hire today you need to have planned for this, and we've been planning for this.
So what do you think this means in terms of capital markets activity outside of M&A? If you are a private equity-backed company or a mid-sized technology company, do you sell or go public at this point? I mean, how many options are there next year?
Look, there's a multitude of opportunities for monetizations. You've got regular way M&A. You've got dividend recaps and create capital through the credit markets. You have IPOs. You have continuation funds. If you're a private equity investor, you're looking at all of those options. I think the challenge with the IPO market is the shadow pipeline of companies that are owned by private equity firms that are looking to go public is enormous. And for many of those companies, that first foray into the markets is going to be almost all primary. And that means that there's very little capital return for the private equity firm, and it's a multi-year process to monetize their stake. So I think the preferred alternative is going to continue to be sales of companies or continuation vehicles.
It's interesting because if you went back a couple of years ago, you would have most investors looking at PJT and saying it's mostly an M&A boutique investment bank. But then you do things like a large-scale capital raise for Boeing, which of course PJT was an advisor on. What does this mean about your ambitions in capital markets outside of M&A?
Well, we are a capital-light advisory firm. It's all about intellectual capital. It's not about financial capital. Rule number one, if you build a firm around intellectual capital, make absolutely sure that you have more intellectual capital than anyone else. And that means you need to have presence around the globe. It means you need to think about advice in the broadest possible ways. So from the earliest days in our firm, we've thought about having the most sophisticated debt capital markets advice, equity capital markets advice, strategic investor relations, activist defense, geopolitical advice. And we've always thought about delivering the most sophisticated advice to the most sophisticated clients. And you can't do that if you don't have those capital markets insights. So we've spent a lot of time building that out.
So, Paul, I now want to turn to the big topic of next year, which is, of course, Trump 2.0. When you think about what might change, what are you talking to clients about? What's most on their minds about the future policies of the next administration?
Well, I'm not even sure where to start. So we can talk about tariffs. So there's what has been threatened, there's what may be negotiated away, and there's what may ultimately be implemented. I think in many respects, this administration is going to be highly strategic in their use of tariffs, and I think it's too soon to tell. But one thing is clear, companies that don't have exposure to the United States want to have more exposure to the United States. If you look at European companies, 10 or 15 years ago, 15% of their assets were in the U.S., that number has grown to 30. It's almost doubled. You're going to see a continuation in that trend. That's number one. Number two, clearly less regulation, more pro-business environment. I think that's going to facilitate more confidence, more investment. You see it reflected in the stock market. You see it reflected in CEO and boardroom confidence. That's going to beget more activity. And then on competition, the reality is that in Trump 1 and in Biden 1, you had similar number of transactions that ultimately were blocked. The difference is that the Trump administration took a much more forward-leaning, let's negotiate behavioral remedies, let's see if we can figure out the deals that we really want to block and let the others move forward. Since that time, the time between announcement and close has increased 50%. That's chilled M&A. I think you're going to see, with the exception of a focus on retail and on tech, you're going to see a much more favorable competition environment.
Well, that's what I was going to ask also, because you saw the Kroger-Albertsons deal get blocked. Pretend I'm a client and you're advising me and you were to tell me, well, okay, your deal would not make it through. What kinds of deals do you think those are?
Look, clearly there are real concerns with big tech. I think the way this election was debated on issues, inflation is a real issue. Therefore, retail, where the consumers feel it, consolidation there is a big issue. So I think those two industries are going to continue to be in harm's way, big tech and retail, and you need to think about those industries differently. I think the second is vertical integration. There's always been concerns about vertical integration. I think those are going to persist. But what's going to be different in this administration is more behavioral remedies, more willingness to negotiate fixes to get deals approved. And I think you also have to get beyond the United States. You have to look in Europe. If you look at what's happened in the EU, look what's happened in the UK, their anti-competition approach has arguably harmed many of the European companies and chilled business activity in Europe. Our sense is that that mood is shifting, and I think you're going to start to see a more constructive approach to competition coming from Europe as well as the United States.
Why not now bring the conversation full circle? My last question to you, PJT stock this year alone has risen more than 50%, more than 55%. If you look over your lifetime since PJT went public, it's almost 700%. You've grown quite rapidly over the number of years. What's going to be the next leg of growth for PJT? How do you sustain that growth rate?
Well, what's wonderful about our firm is we're 9 years in, we've accomplished a great deal, but we're just getting started. If you look at our footprint in strategic advisory, it's not even half of those of some of the balance sheet light firms that we compete against. When you think about all the geographies that we have yet to fully conquer, we have tremendous white space. When you think about all the industries that we're not really present in, we have opportunities to dramatically grow the business. When you think about how well known we are today, it's far greater than when we started, but still not where it's going to be 5 or 10 years from now. So everywhere we look, we see growth. But rule number one is create the best team, deliver the best advice, and let the clients determine how much growth ultimately gets realized. So we're never going to start with growth. Growth's going to be the output, not the input.
Paul, it's so nice to see you today. Of course, have a great rest of your year. That is Paul Taubman, of course, the CEO and founder of PJT Partners. Guys, back to you.
All right, our thanks to Sonali Basak, of course. Much more coming up in our 10 a.m. hour from Sonali down at the Goldman conference, so don't go anywhere. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, William Blair is downgrading Dave & Buster's, saying it's no longer a buy. The arcade restaurant chain posted a drop in third quarter sales and announced the resignation of its CEO. You can see shares down 15%. Next up, we have Citi saying that Bausch & Lomb is no longer a buy, downgrading the eye healthcare company to a neutral. The analyst cites competition pressures, and you also have the FT reporting that Blackstone may pull out of a joint takeover bid for the company. That's sending shares down about 11% right now. And finally, we have Barclays downgrading home builder stocks this morning, including Lennar. The firm says it's no longer a buy as the home building utopia looks more and more out of reach. That is a direct quote from that analyst. And it's interesting with the home builders. I mean, they were so hot for so long, but it feels like that trade has kind of cooled. Lennar in particular is only up about 9% year to date. And over the past 5 years, it's had quite a run. So, nothing gold can stay, Matt.
Yeah, well, that's not true.
I don't know.
I hope that's not true.
I heard that in a poem somewhere.
I've been hearing that from you a lot lately.
Yeah.
These markets seem to be holding up quite well. I mean, even though we had a drop over the last couple of days, we still hovered above 6,000, and we're holding firmly above that level now on the S&P 500. So it does look like there is confidence, even after the CPI print, that the Federal Reserve is going to cut rates on December 18th, which is only 1 week from today.
7 days exactly. I know that you're going to be on vacation. I'll miss you dearly, but I don't know. If I were you, I would tune into that press conference. I feel like Jerome Powell has a lot of explaining to do.
Yeah, it does look like they're pushing past data dependence. And look, we talked yesterday with Barry Knapp from Ironsides. And one of his predictions for 2025 is that the terminal rate is going to be down at 3.25. That's much lower than the market expects.
That was interesting.
And I like the sort of deep state conspiracy theories that the Fed has to get rates down because we owe so much money and we're paying so much interest on the debt.
I know that's not the only conspiracy theory that
I'm into a lot of them.
You like to entertain, but we probably shouldn't get into that now. We have a great lineup coming up in the 10 a.m.
I'm looking forward to David Gura's interview with the U.S. Treasury Secretary Janet Yellen. That's an exclusive interview with the Treasury Secretary out of Washington, D.C., one you don't want to miss. This is Bloomberg. We are 30 minutes away, 30 minutes into, I should say, the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld, Sonali Basak on assignment. And coming up, core inflation rises for a fourth straight month. Somehow that firms up bets that the Fed is going to cut rates at their meeting next week, looking past some of these price pressures. We'll also speak to Janet Yellen. She is the first woman to head the U.S. Treasury. She'll sit down with Bloomberg's David Gura as she prepares to leave office. We'll bring you that exclusive interview at 10:30 a.m. Eastern. And as more companies dust off their deal-making playbooks, we'll get the outlook from Marc Nachmann of Goldman Sachs and Mike Arougheti of Ares. But before we get there, let's take a look at these markets. We are 30 minutes into the trading day, and you can see we have a rally on our hands and then some. The S&P 500 rebounding from 2 straight days of losses of about 0.7%. Big tech in charge right now, Matt Miller. The NASDAQ 100 of about 1.3%. The bond market relatively quiet as CPI comes in line with expectations. 10-year Treasury yields down just a basis point.
I'm looking at the drivers on the S&P 500, and as you'd expect, in terms of adding points, Nvidia, Google, Amazon, Broadcom on that Apple story. But it's the big mega cap tech stocks that continue to drive us higher. And I want to talk to Ann Miletti about how much longer that's going to last. She is Allspring Global Investments head of equity, and you know, this has been the case not just for this year, but last year as well. And at some point, there's going to be a rotation. I mean, we've seen signs of it, but do we see these leaders ever sort of standing back? Do people sell Nvidia and use it to buy Russell 2000 stocks?
It's a great question, Matt, and I think what we see is some of the concentration that we saw in the markets starting to spread. So instead of just putting all of your assets in 5 or 7 names, maybe not selling those names, but trimming back a little bit and diversifying across. And since July, the equal weighted S&P 500 has actually outperformed the weighted index, which does show signs that other companies are performing. And it's really based on fundamentals. It's earnings are starting to, the magnitude of earnings increases is starting to spread beyond those 7 names, and you're starting to see a little bit of deceleration, even though still decently good growth in those big names, but a little deceleration nonetheless.
Well, talk us through the earnings outlook for some of those broader names, because you take a look at small caps, for example, and you still have some hiccups there. We were talking to Cameron Dawson about that yesterday, the earnings picture there. But when you take a look at the sector level and you think about some of those underloved sectors, let's get specific. I mean, where do you think that you could really see that earnings strength come through?
Yeah, when I talk to our portfolio managers, they do lean towards some of the more cyclical sectors. Healthcare is also a really big one that our PMs continue to see a lot of value. Med tech space, the diagnostic space, those names have been hit hard by the COVID trends and the usage trends declining during COVID, but also because of Ozempic and the other issues, right, that hit their multiples. So not just their fundamentals, but their multiples have also declined. And you're starting to see earnings rebound in some of those areas. And, you know, if you get multiple expansion on top of that, there's a lot of room to move in some of those areas.
One of the things we've been talking about a lot over the past couple of weeks and months is that U.S. exceptionalism is at the fore, right? This is really the only game in town, it seems. But at what point do other regions start to look attractive as investors, not just here, but internationally, also ignore them?
Yeah, it's such a great point, because there are areas of the market where investors just aren't playing. And I would say the emerging market space is one of them. Sentiment is really low. There's been challenges with a lot of geopolitical risk around the globe, which none of us can ignore. And now you have a new administration that clearly is talking about tariffs and pressure that also could cause on some emerging markets. But if I had to kind of pick a dark horse for 2025, I'd take a little closer look at emerging markets because of the sentiment being so negative. If you also look at the MSCI Emerging Markets Index relative to the S&P 500 index on a PE basis, it's trading at half. And that's a 20-year low. So valuation will not get you returns. But if you have any fundamental improvement, you know, we see China playing around with stimulus. If they get a little bit more serious about that, we saw signs of that in September. What happened? You had a 30% rally in China. Why? Because investors had to rush back. And so I would say pay a little attention to allocation where people are ignoring the space.
Right. Well, you bring up China. That's exactly where I wanted to go because for that dark horse to win the race or whatever dark horses actually do, I mean, do you need that China participation? Is everything correlated when you take a look at the emerging markets, or are you starting to see more idiosyncratic stories come through?
Well, when I talk to our emerging market PMs, they really are focused on all regions. Certainly the index is highly concentrated in China, but they've won in areas like India, areas like, Taiwan and, Southeast Asia and other places other than just China. And if you look at the dispersion within the emerging market regions, it's huge, which means active management has a real chance to out-select if you have boots on the ground and people who are really getting to understand those regions and those companies and pick the right ones.
And back here in the U.S., there's an amazing story today on Albertsons and Kroger, right? That deal scuttled, but there's also a story about Andrew Ferguson now going to be coming in to replace Lena Khan at the FTC. And I wonder if that's a real sign that M&A could be off to the races in 2025.
I do believe, look, the IPO market is heating up already. We're seeing M&A, they had the earlier announcement this week between Omnicom and IPG as well. Those types of announcements, I think, are going to continue. There's been a lot of money on the sidelines held by corporations not knowing exactly what to do until they understand the rules. Right. Yeah. And so that money is going to get unlocked. You also have private equity who have been sitting on a lot of companies that they would like to, take public or, do something else with. So I think we're going to see a lot of activity pop up. Right. That is also good for that small and mid-cap space.
All right, Ann, got to leave it there. Really great to get some time with you. That is Ann Miletti of Allspring Global Investments. Now, coming up, we'll speak with Ares Management CEO Mike Arougheti live from the Goldman Sachs Financial Services Conference. That conversation up next. This is Bloomberg.
I'm Sonali Basak. I'm sitting here at the Goldman Sachs Financial Services Conference. Welcome to our Bloomberg Television and radio audiences. I'm standing by now with Michael Arougheti, the CEO of Ares Management. And you broke records, record after record, really.
Nothing
this
but
year.
records.
Nothing but records. So how do you even begin to set up for 2025 when it was a record-breaking fundraising year for you in many ways?
Yeah, well, the year's not over, so hopefully we'll have a good push to the end of the year. This will be a record fundraising year, but what's nice about the way that our business has evolved and developed, 10, 15 years ago, we and others like us were very dependent on the traditional institutional market for fundraising. If you look at 2024, about 30% of our capital raising is actually coming from that traditional institutional part of the market. The other 2/3 is coming from places like wealth and retail, our publicly traded permanent capital vehicles, our insurance business, our CLO franchise. So there's been a broadening out and deepening of our product set and our fundraising capability, which means that when we're going into a new year, we're doing it from a much higher base. So we're equally as optimistic for what next year holds as well.
Fascinating. What does it look on the other side? If you're raising all that money, you need to put it somewhere. Are you finding enough investment opportunities, even with the record-breaking fund that you just had? Did you find a way to put a lot of that to work yet?
Yeah, it's actually, as we grow, we keep investing in our deployment, which is the big, driver of our business. If you look at the last couple of years, as our dry powder has grown, so has our deployment, almost 1 for 1. So we need to keep investing in new products, new markets, people, et cetera, which we're doing organically and inorganically. So my expectation is deployment will pick up in 2025. M&A market feels like it's picking back up. Transaction volumes are accelerating. So we had a really good year, but I think 2025 is setting up to be another good year.
What role is M&A going to play? There's an expectation of this big return, but of course you have a lot of concerns from private equity sponsors still out there. There's also a lot of uncertainty around interest rates, particularly if those Trump tariffs come to play.
I think that is the big question in my mind for 25 is the trajectory for rates and the impact of tariffs. We have believed and now continue to believe that rates will stay higher for longer. That's actually really good for our private credit businesses, just because we capture all of that excess return. It's not so good for the M&A market, and so I think 2025 will, have to strike that balance. That said, there's a lot of pent-up demand to transact, right? You have people that have largely been sitting on the sidelines for 24 months plus. The capital that they manage has, a timestamp on it. It needs to get invested. It needs to get returned to their investors. So I think it's more important that we have rate stability at this point, as opposed to needing to see rates come down dramatically in order to see the transaction volumes.
But do investors have it totally wrong? You look at the expectations for rate cuts, you get to as low as 3.5%. And do we get there? Or do you think that there's actually a risk that rates go higher next year?
I don't know if there's a risk that they go higher. I think that there's a real possibility that they stay high. A lot needs to go right or wrong, depending on which side of the market you're in, to see them actually move back up. But I think that there's a real strong case to be made that they will stay higher for longer, and probably higher than the forward curve is predicting. But again, we've lived in a 3.5% and 4% base rate environment before. And so it's not as though the markets can't function well there. The key is, how do we transition? And we're already beginning to see, the markets transitioning to the new cost of capital, and that's really all you need to see volumes pick up.
Now, Mike, a week ago, the big elephant in the room, HPS sells to BlackRock. Yeah. Huge deal in the industry. What did you make of it? From where you're sitting, do you think that it changes the competitive landscape in a significant way? Yeah,
so first of all, I'm super happy for all of them. I think it's a great partnership, two great companies coming together. I don't know if it necessarily changes the competitive landscape, right? If I look at, we've been in this business for 30 years, and we've seen our competitors get bought before. We've seen Oak Hill get bought by T. Rowe. We saw Antares get bought by CPP. We saw Churchill get bought by Nuveen, right? That doesn't necessarily change the competitive dynamic. I think the competitors are the competitors. More importantly, from my lens, and maybe it's self-serving, I view it as a real validation of the competitive advantages that you create through scale in private credit, right? So when a company as well-positioned as BlackRock chooses to buy HPS for 30 times, it's really, for me, a validation of the private credit, investment thesis. And so viewed through that lens, I think it's a great thing.
What does this make of consolidation across the industry? You yourself have been a significant consolidator, but you have looked really outside that traditional private credit business of late. You went into real estate in a much bigger way, for example. Does that mean that the direct lending businesses as we know it is kind of at its peak, and you need to look elsewhere to consolidate in order for the real growth in private markets?
I don't think so. From the Ares perspective, I don't think so. We are capturing a growing share of a growing market in the core corporate lending business, but we're also seeing the opening up of new markets, real estate lending, asset-based lending, infrastructure lending. We're globalizing the business, so we have a significant runway in Europe and Asia. So even if people believe that there's a maturation in the core U.S. direct lending business, that's really just a small fraction of the investable market, and we've already set ourselves up to grow in other parts of the world. I do think, though, that consolidation in asset management will continue. We have learned over the last 10 or 20 years, size matters in this business. You need to be able to invest in growth, origination, portfolio management, technology, fundraising, and that's a sizable investment. And so the big will get bigger. They'll do it organically, but they'll also fill in gaps in their product set and capability by making acquisitions as well.
Well, speaking of those other capabilities, you're talking about real estate for a moment here. I mean, what is the biggest opportunity, particularly when people are looking around some of the parts of the industry and still seeing some pain, either pain on the office side, or maybe you could argue over exuberance on the AI data center side in some ways. How do you feel about the opportunities
look,
up there?
Real estate is always talked about as a hyper-local market. We would agree. It matters not just what market you're in, but what street and what street corner you're on. And so I think in order to be great at real estate, you have to be broad in your footprint and broad in your capability. You're right. There's distressed opportunity or transitional opportunities in office. There's growing opportunities in data centers. We're making significant investments in industrial real estate to take advantage of what we perceive to be a realignment of global supply chains. So there's a lot of different ways to play real estate. I will say, though, things that drive value in real estate going forward are going to be rates. Again, whether they come down fast or not, stability in rates is a positive for real estate growth. Economic growth, and we're continuing to see strength in the U.S. economy. That will, drive transaction volumes, and then supply. And I think one of the things that people don't fully appreciate is because of the headwinds that the real estate market has had over the last couple of years, the market is fundamentally undersupplied, which does two things. It supports the value of the existing assets that people own, and it's going to create demand for new development and new capital coming into the market. So you got to pick your spots, but I think generally when you view it through the lens of rates and supply, there's a tailwind going into 2025.
I believe rates are staying higher for longer. Then you also said a potential distressed opportunity in real estate. How big is that distressed opportunity, and would you play in it? Would you want to invest in it?
Yeah, we cover the waterfront in terms of our real estate positioning. Multifamily and industrial have been our two largest exposures, but we also play to an increasing extent in data centers, student housing, self-storage, so other growth markets. We've largely avoided office in the primary market. We have large pools of capital that are geared to invest in opportunistic real estate equity and opportunistic real estate debt. So what we've learned in past cycles is the way that distress plays out is sometimes it's a secondary market opportunity where you're buying, good assets at good basis. Sometimes it's just a shift in the competitive dynamic in the primary market. So you have to be prepared for both, right? If banks who are overexposed to commercial real estate office don't sell those assets, that probably means they're going to be less competitive in the primary market. So you have to be prepared for either outcome.
Mike, we're running out of time. We have to leave it there. Of course, a big setup for 2025. That is Mike Arougheti of Ares Management. Back to you.
All right.
Our thanks to Sonali Basak and Mike Arougheti of Ares. And still ahead, more coverage from the Goldman Sachs Financial Services Conference. We have Marc Nachmann. He is Goldman's Global Head of Asset and Wealth Management. He joins us later this hour. This is Bloomberg.
Let's get now to high interest. Look at what's making headlines around the world. The suspect in the murder of a top United Health executive is being held without bail in Pennsylvania after fighting extradition to New York. Authorities here in New York have gathered evidence against Luigi Mangione, including surveillance video, autopsy results, and written admissions. They're seeking his return to New York to face second-degree murder and weapons charges. And, of course, he was caught with a ton of evidence on him as well. Albertsons is suing Kroger, claiming it failed to exercise best efforts to take any and all needed actions to secure regulatory approval for the company's proposed $24.6 billion deal. Albertsons is seeking billions of dollars in damages. That's in addition to the $600 million termination fee it gets automatically. Albertsons' acquisition of Kroger was blocked by a federal judge who said the takeover would decrease competition and hurt U.S. grocery shoppers. The company spent nearly 2 years attempting to merge with Albertsons, aiming to become a bigger player and compete against larger rivals like Walmart. And President-elect Donald Trump has picked Andrew Ferguson to chair the Federal Trade Commission. Trump says Ferguson has a proven record of standing up to big tech censorship, whatever that means, and supporting freedom of speech. Ferguson, who is already one of the FTC's 5 commissioners, will replace Lina Khan, who faced criticism from Wall Street and Silicon Valley for blocking billions of dollars worth of corporate acquisitions and suing Amazon and Meta. And this is really interesting, Katie, because Lina Khan has been championed by J.D. Vance, who is, of course, the vice president-elect. So you have to wonder how much is going to change there. Of course, they're putting in a GOP commissioner who has fought her on some rulemaking changes.
Yeah, I remember that was a narrative for about 30 seconds that maybe Lina Khan will keep her seat because J.D. Vance likes her. But obviously that did not end up playing out. And we just heard from Goldman CFO actually saying that this pick in particular, Andrew Ferguson, could spur more M&A activity. That, of course, has been the expectation for a while. But
most people
Yeah,
Most people
except for
think
one Bloomberg opinion
the
columnist.
Bloomberg opinion writer Chris Hughes says,
yeah,
don't count on it, but literally everyone else that we've spoken with is
we
for
should
it.
have him on since we keep bringing up
We
his
should.
name.
I mean, the other people are talking their own book, right?
Yeah.
And he doesn't have, I imagine, much skin in the game. So we should get Chris Hughes on this
if
show.
you're watching. I do think it's interesting, though, because even with all of this optimism, this new FTC pick, there's some deals that can't be saved. You think about Kroger and Albertsons just this morning, for example, and then Tapestry and Capri a couple of weeks or months back at this point. So even though, of course, the landscape will change, there are certain deals that just won't get to the finish line.
That's for sure. But Ann Miletti from Allspring, we just had on, made a great point in that so many companies have so much cash ready to deploy, you know, and because of the FTC's activism over the last 4 years, you know, maybe they were holding back to some extent, and maybe now it's off to the races.
So perhaps some cash on the sidelines.
I wasn't going to use that phrase.
You were getting close.
But what, Berkshire Hathaway has like $325 billion, and clearly they want to make acquisitions with at least a portion of that.
I mean, then the question becomes, I mean, are there attractive targets out there if you're Berkshire Hathaway and Warren Buffett? But should be exciting. But stick with us. We have more from the Goldman Sachs Financial Services Conference. We also have an exclusive interview with Janet Yellen coming up, so stay tuned. This is Bloomberg.
This is Bloomberg Open Interest, and I'm Sonali Basak, and I'm standing here at the Goldman Sachs Financial Services Conference over here now with Marc Nachmann, who's the Global Head of Asset and Wealth Management at Goldman Sachs. This is the big growth area. This is the focus that Goldman has been kind of honing in on, and you have set out a plan to be less balance sheet intensive and focus more on that third-party fundraising, third-party business. How far along in that journey are you, especially when you have some ambitious plan to even double assets in some part of the business?
That's right. We set out an ambitious plan at the beginning of last year when we formed Asset and Wealth Management. We had an investor day in February, set out some targets, and I think we're well on our way on meeting and exceeding a number of them. You know, the key was, you know, growing durable revenues, high single digits. We've done this over the last 7 quarters, getting our pre-tax margin into the mid-20s. We're now at 24%, so we're well on our way. And as you mentioned, we had a couple targets in terms of reducing our balance sheet intensity and fundraising on the balance sheet. We, at the time, beginning of last year, were at $30 billion of our historical principal balance sheet. We had a target to get to $15 billion by the end of this year. We're going to exceed this. You know, at the end of the third quarter, we were around $12 billion, so we'll continue to make progress by the end of the year. So we feel really good about reducing the balance sheet. At the same time, we've had a very good time raising funds in the alternative area. We had a target of $250 billion of fundraising, which we've met. We expect now this year to raise more than $60 billion of alternative assets. So we feel very good about the transition from the kind of balance sheet intensive business to a balance sheet lighter business, and at the same time, you know, continue to grow our management fees, and we feel good about exceeding our target of the $10 billion number for this year.
I'm really curious about the private credit part in particular, because you look over across the island over in Manhattan, and you see BlackRock making an acquisition for HPS to get much bigger in the private credit space. How does that make you think about the future of M&A in this business? Do you think that you need that M&A to get much bigger in private credit, especially when you yourself have a plan to more than double assets in that business to $300 billion?
Yeah, we feel really good about our position. We're a scaled player in private credit. We've been in the business for 30 years. We launched our first mezzanine fund in 1996. So we've been experienced players throughout the cycle, and we're in a very unique place where we're a scaled player, but we're also closely attached to the world's leading investment bank. And so when you think about that, you know, the origination capability we have, which is one of the key things when you think about private credit, is unmatched. And so I think we think we have what it takes to continue to grow. You know, we have the scale right now, and we think we're going to be able to more than double the business over the next few years.
Does that mean M&A is off the table, whether it is in private credit or another area for Goldman Sachs?
I'd say generally speaking, we have very strong growth opportunities that are organic, and so we're very focused on those. We're obviously paying attention to what's going on in the market, and so if we see something that could accelerate our growth, we'll take a look at it, but the bar will be high.
What do you make of the not just private business, but the public business here? Because in addition to doubling down on private assets, you've been doubling down on the ETF business as well, making notable hires, including from JP Morgan. Does that mean you're setting out to compete and be much, much bigger in this business and take on the likes of JP Morgan and BlackRock?
Yes, I think we are. I think on the traditional business, I would say we're very focused on the solutions orientation there, and so I think we are a leader in SMAs, and we already have a very strong position. We want to become a leader in active ETFs. I think really our heritage is be active asset managers across both the traditional and the alternative side. So we're very focused on that. We've launched 10 new ETFs this year. We're going to launch a number of ETFs next year, so we're going to grow there. I think we see a greater adoption of ETFs just in general, but also within models. I think one of the things that our clients are really interested in is having model portfolios and getting Goldman Sachs model portfolios. And ETFs tend to be parts of these model portfolios as well as SMAs. And so I think we think this whole solutions space, the whole model space is a big growth area for us.
When you think about the path forward here, what do clients want at the end of the day? Are they looking more to be in those public markets or the private ones? How do you differentiate where there's going to be the most growth in the next 5-10 years?
Yeah. I think clients want a combination. I think it's interesting. We obviously have a very big wealth manager that is focused on the ultra high net worth segment, and so we see asset allocation there. And I'd say people want a combination of public and private assets, and I think it's important to have that combination and have the ability to move between those two sides.
Do you believe that there can be this great convergence where public markets look more like private markets and vice versa, or do you think they have to be separate?
I think it'll get more and more blurred. I think the difference between the two markets. I think it's interesting. You see some private credit deals that trade secondary, and so you see some liquidity in some of these deals. And so I think there's a lot of discussion. We've participated a lot in private company that have equity that is broadly distributed to employees, for example. Employees want liquidity. There's ways to create liquidity for private companies. And so that always blurring the line between what are private illiquid assets and what are public liquid assets.
Now, the other big business you have, and we were just talking about this in the commercial break, big money market business. You think about that wall of money still sitting in money markets. There's a big investor expectation that moves. Have you seen it? Are you seeing it as rates start to fall?
I think when I look at our money market business this year, we've not seen material outflows into equities from the money market. So a lot of people still keep their money in money markets. Yields are still pretty attractive. I would also say that our business is probably more tilted towards institutional and corporate clients versus retail clients, but we still see people holding on to their money market assets for the time being.
Now, you don't just run the asset management business, you also run the wealth business. This has also been targeted as a growth area for Goldman Sachs. When you think across the world, where are you going to grow? Are you going to hire significantly to get that job done?
Yes. So we have a long history of growing our wealth business, high single digits for many years, really based on great investment performance and a great client experience. And I think those are kind of the key two pillars driving our wealth business. And we're very committed to continue to growing it both in the US as well as internationally. So we have kind of a long-term plan to add advisors both in the US as well as in Europe and Asia. We've done this year. We'll continue doing it next year and the year thereafter. And so we're going to consistently growing that business. We're also expanding our private bank capability, which is something we had historically done less. And so we're getting better in lending in that business, which is a very good, attractive business to be in. So both of the advisor growth as well as the expansion of the private bank, on top of good investment performance and client experience, will allow us to continue to grow this business.
If I know anything about you, is that you're a man who focuses on the numbers. Where are you wanting to be number one tomorrow that you are not today?
Look, I'd say we talked about private credit. We have a great private credit franchise. We have a kind of top 5 alts franchise overall. We want to move up there in the ranking. We're a top 5 active asset manager on the public side. We want to move up in the ranking. This goes to ETFs and model portfolios and other solutions parts of the business. I'd say the interesting thing about our wealth business is entirely focused on the ultra high net worth segment. We think we're a leader in that industry. There's not a lot of good data around where exactly we rank, but we think we're a top player globally in that business, but we definitely want to be the number 1 ultra high net worth player globally.
We're looking forward to following that story. That is Marc Nachmann. He is the global head of asset and wealth management over here at Goldman Sachs.
All right, our thanks to Sonali Basak there. Let's get to some breaking news right now, and that is that Hershey's main owner is said to reject Mondelez's offer as too low. This is a Bloomberg News scoop. Remember, we reported yesterday or earlier this week, time is a flat circle, that Mondelez made a preliminary approach for Hershey. That was according to people familiar with the matter. But now we are getting that news that Hershey's main owner has rejected that prelim offer. Again, we also got some news from Mondelez this morning when it comes to their buyback plans, approving an up to $9 billion repurchase of their Class A shares.
That's right. And so this is interesting, right? Because when we got that buyback announcement, a number of analysts, including Bloomberg Intelligence analyst Jennifer Bartashis, basically said it pours cold water on the idea of M&A. Jennifer actually said it signals that Mondelez remains committed to shareholder returns. They have a big authorization program in the past. May not mean much in relation to its potential interest in Hershey, but Adam Christofouli at Vital Knowledge said the company remains committed to an acquisition strategy that's focused on bolt-on acquisitions. And Hershey is, remember, a $35 billion company. It has been a $45 billion company. So it seems unlikely that Mondelez is going to be buying back $9 billion of shares and also pursuing a $45 billion acquisition when they only have like less than $2 billion of cash and equivalents on hand.
I don't know, maybe they have another whole pot of money, the pot of gold that we don't know about. But bringing it back to this specific news that we just got, we're talking, of course, about the Hershey Trust, as we talked about with Crystal C. Yesterday or the day before. They control.
Was it yesterday? Can someone in the control room remind us? Because was it Monday or was it Tuesday?
I don't know. It was the other day. In any case, they control roughly 80% of the voting power over at Hershey, turning down this bid seen as too low. Of course, a lot of questions there about whether Mondelez was pursuing when it comes to their buyback plans. But in any case.
All right, we are going to go now live to the U.S. Treasury, where David Gura is sitting down with the Treasury Secretary, Janet Yellen, for an exclusive interview.
Welcome to our TV audience and radio audience worldwide here in the Treasury Department with Secretary Janet Yellen. Great to be with you, and there's a lot I hope to cover. And I wonder if we could begin first with your work on the world stage. We can start with Ukraine. And something that Bloomberg reported overnight is that you and the administration are considering new sanctions on Russian oil, perhaps looking at Russian oil exports, at these shadow tankers that the Russian government has. I guess, first of all, I wonder if you can confirm that those conversations, those discussions are underway.
Well, let me say we never preview sanctions, and we've constantly been tightening our sanctions on Russia. Our overall aim is to impair Russia's ability to continue conducting this brutal war, to try to deny it the military equipment. It needs to be able to do that, and we've taken a variety of steps to do it. But we have been focused since the outset on Russian oil revenue. It's a critical component of the Russian budget, and we've been looking for creative ways to try to reduce Russia's revenue. One of the most creative policymaking things that I've been involved at during my career occurred here in Treasury when we we're able to devise a way and convince our allies to join us in this, imposing a price cap on Russian oil, which was a way of avoiding price spikes when the war started for oil, and actually succeeded in keeping Russian oil flowing into the market. So we continue to look, of course, over time. While these sanctions have been effective, Russia has invested a lot, its own fleet of ships to carry its own oil. We cut it off from allied ships, new insurance that have been costly to Russia to have to make those investments. Now, what's unusual about this moment is that the oil market seems to be well supplied.
Prices are relatively cheap.
Prices are relatively low. Global demand is down, and there really has been an increase in supply. American firms have stepped up. We have vastly expanded oil production. OPEC countries like Saudi Arabia have excess capacity at this time. So the global oil market is softer, and that creates possibly an opportunity to take some further action. We're looking at it.
You talked about creative policymaking, and so vis-a-vis Ukraine, there was a moment this week when you dispersed $20 billion to Ukraine alone, and that'll be paid for with interest on frozen Russian assets. So another creative piece of policymaking that you've been involved with. We're at this moment where I think there are a lot of questions about what policies can remain in place. And I wonder, when you look at that in particular, are you confident that under a new administration, that program can continue in perpetuity?
Well, we have worked with, if you're talking about the so-called ERA loans, extraordinary acceleration loans, we've now transferred $20 billion, which is the United States contribution to this loan package to the World Bank, to a financial intermediary fund that was set up to channel these monies over time in coordination with our allies to Ukraine as it's needed. So, and as you mentioned, importantly, this is not using U.S. taxpayer resources. These loans will be paid off over time by the extraordinary or windfall revenues that are being earned in Europe at Euroclear on the Russian assets that are being frozen there. So Russia is really helping with this to pay Ukraine to, help it fight the war. So I feel confident that this is something that can stay in place. And what we're really trying to do is to strengthen Ukraine's situation, its ability to defend itself, and hopefully at some point to come to the table to bargain with Russia for a just peace. We want to strengthen its ability to have the equipment it needs, to have the money it needs to continue to finance schooling and emergency services to its people, and to put it in the best possible situation to support a lasting and just peace.
Let me pivot to China, and this has been a relationship I think you've invested a lot of time and energy in, kind of rebuilding a conduit of communication between Washington and Beijing. You have deputies right now heading to China for meetings with their counterparts, meetings taking place in South Africa as well, reportedly.
Yes.
There is concern about what would happen if that relationship, the U.S.-China relationship, were to return to the place it was in when you took office now 4 years ago. How much does that concern you, and what would the consequences of that be if the efforts that you've put in to rehabilitate that relationship go to the wayside?
So I do think it's important to have ongoing communications at all levels, from the president and Xi talking to senior U.S. officials to staff that need to communicate. Just having open channels of communication is valuable, and I believe it will be seen as continuing to offer value. These are channels by which we can make clear what we're unhappy about, where our concerns are and why we have them. Well, we have significant concerns about Russia's economic policies that we discuss in these channels. It's also the case that we have shared global interests, whether it's in climate change, combating pandemics, dealing with potential financial disruptions that could affect global financial markets. We're also using these channels to build trust in channels for cooperation so that we can work together where our interests coincide. So there's no question that we have serious concerns both from a national security point of view and a broader economic view with China's behavior. But nevertheless, as the two largest economies in the world, it's critical to have open channels of communication. It helps avoid misunderstandings. We've used these channels when we've taken action like export controls or our recent outbound investment restrictions to explain what we're trying to accomplish to avoid misunderstandings that can worsen the relationship needlessly.
You have a particular insight into what makes your counterparts tick, I imagine, through those conversations that you've had. And so we've seen the president-elect talk about large, universal, punitive tariffs. Do you have any insight into how they might respond if they are threatened with something like that?
Well, I really don't want to make a forecast. Many countries, when they're faced with unilateral actions of that sort, look for ways to retaliate, and my guess would be that they would do that. We have in areas of concern where I've expressed repeatedly concerns with overcapacity that is developed in Chinese advanced manufacturing industries and clean energy, semiconductors, and the like. We think it reflects active, large subsidies that are flooding the world with exports and threaten to drive our firms out of business in areas that we think are critical to our own future. We've put in place tariffs. Now, they're strategic. They affected $18 billion worth of trade, certainly not all of our trade with China. And we did it to make sure that China's actions don't undermine our own plans to support these sectors. But broad-based tariffs, almost all economists agree that what they will do is hurt us by raising prices, possibly substantially, and making it more expensive for firms that need inputs from China to be able to acquire them, and harm our competitiveness of firms that rely on those imports. So we've taken a strategic approach, focusing narrowly, and a broad-based approach I have serious concerns with, as most economists do.
There's been a lot of talk about the dollar, the safety of the dollar as a global reserve currency. And I wonder if that's something that you think Americans should be preoccupied with. It's something that we hear about from the president-elect and his team. Something else they've floated is perhaps the opportunity for a successor to the Plaza Accords. There could be, as it's been put, a Mar-a-Lago Accord where you could get the U.S. together with Europe and China and Japan, maybe talk about domestic production, how to narrow trade deficits. Is there an appetite or an opportunity for that? And is this something that you think most Americans should be worried about?
Well, you started by asking me about, I think, the reserves,
the reserve
role of the dollar. And the use of the dollar in global transactions and financial markets and in trade is underpinned by a very strong U.S. economy with deep and liquid capital markets, the role of treasuries as the safest asset in the world, the rule of law, a well-managed economy with low inflation, and solid macroeconomic policy. And when you think about what other currencies could possibly replace the dollar, the list is short. Possibly there's no currency that at this point could possibly rival the dollar. So I do think it's advantageous to the United States that the dollar is used as the reserve currency. But I don't see the dollar under threat. And in terms of an agreement that could affect the value of the dollar, you know, the policy that our administration has articulated is that major countries should have the value of their currencies determined in world markets. So intervention might be appropriate on occasion to counter extreme volatility, but we believe that it's best for markets to determine the value of the dollar, and there hasn't been any intervention in foreign exchange markets. I think it should stay that way. Now, we do issue a foreign exchange report twice a year. We are not approving of countries that attempt to manipulate their own currencies to try to gain a competitive advantage. And we're very attentive and react strongly when we see countries manipulating their currency to try to retain an advantage. And of course, we work with our other countries routinely to discuss coordination of macroeconomic policies to make sure what we all do translates into success for as many countries as possible in the global economy.
I'll ask you a last question just about the fiscal outlook. The person that Donald Trump has named as your presumptive successor, Scott Bessent, has suggested that he wants to cut the deficit in half by 2028. Is that necessary? Is that even possible? I guess what I'm asking more broadly is how worried are you about the fiscal outlook at this point in time?
Well, I am concerned about the fiscal outlook, and I believe that deficit reduction is necessary to keep us on a sustainable fiscal course. Now, President Biden signed into law $1 trillion of deficit reduction over the next 10 years. He did that in the agreement to raise the debt ceiling. And our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't really done anything to, beyond what I've mentioned, to improve the fiscal outlook, and I think that's a shame. I'm disappointed in that, and I think Congress needs to work hard on that. There is a threat going forward that many of the provisions on the individual tax side of the Job Cuts and Tax Act, JCTA, enacted by the Trump administration in Congress in 2017, they will sunset at the end of next year. And many Republicans have expressed a desire to keep all those provisions in place. CBO said that will cost $5 trillion over 10 years. So that really is, and so that would be a blow in a situation where I believe an additional $3 trillion, that not doing the $5 trillion and $3 trillion more is necessary. And if the provisions are just extended, this will be a serious blow without finding ways to pay for them. We proposed a lot of pay-fors that we think would fairly ask corporations, wealthy individuals to pay their fair share. We've negotiated an international tax agreement that would create a level playing field worldwide for multinationals. The United States has not yet joined, although many other countries have. And that would be a revenue-raising measure that I think would be very valuable. And there are certainly more. So I do hope that the new administration and Congress will, if they extend features of JCTA, find ways to pay for what they do, and also make sure that the benefits go not to the wealthiest individuals, but to middle-class families.
Madam Secretary, thank you very much.
Thank you.
Janet Yellen, Secretary of the Treasury, back to you in New York.
All right, our thanks, of course, to David Gura, sitting down exclusively with Treasury Secretary Janet Yellen, making a lot of headlines, a lot of discussion there, ending on the deficit, which was really interesting, talking about how she's concerned about the fiscal outlook. There needs to be a deficit cut, and that basically that keeping all the Trump tax cuts would be a serious fiscal blow.
Right. I mean, it's tough to cut the deficit during your administration because that would put a real damper on growth. But you hope another administration does it. So she's looking forward to that in Trump 2.0. Speaking of President-elect President Donald Trump, he is scheduled to ring the New York Stock Exchange opening bell tomorrow. So we're going to see him on this program. He is going to visit the NYSE. According to people familiar, Representative for Trump didn't immediately respond to a request for comment. So we haven't confirmed it with his people yet. His people on record, right? We've confirmed it with sources off the record. In any case, obviously, it's a symbol of American capitalism, the New York Stock Exchange. So it'll be interesting to see, and one that obviously he has called out a lot in terms of the importance of gains there. We've certainly seen them since the election.
Absolutely. So a lot to look forward to tomorrow. When it comes to that stock market open, we'll also be talking to the CEO of Lazard as well as David Kostin from Goldman Sachs. This is Bloomberg.